75 to 80, 75.01 to 80% loan to value, they get that rate. 80.01 to 85, that rate. 85.01 to 90, that rate. I say that they have an 80.01% loan to value. We figured it out. What interest rate will you give them? How many people say 5.5? Okay, I'm going to re-educate all of you guys if you're working for me. Why? Is 80.01% just over 80%? There's a couple of differences here. The interest rate's a little bit lower here, right? So we can give the borrower a lower interest rate. What does that make their payment? A little bit lower. What else in a conventional loan would that do? They can qualify for more, but there's a very important thing that happens between here and here. Who said that? I don't have any dollars left, but no private mortgage insurance. In some loans, that could be $300–400 a month. So if I can get them a little bit lower, nice job. No private mortgage insurance, they're going to save a boatload of money. Fair enough? Now the interest rate changes are not usually this significant. I'm just making it for the class. It might be 5 to 5 1/4, 5 1/8, something like that. But you understand, right? But here's why I would re-educate you. What could we do to make this LTV a little bit lower? All right, let me tell you what I do first in the mortgage business. The first thing that we do is we look to cut the real estate agent's commission. I'm kidding. We asked that second. We try to cut the attorney's fee first. Oh, what's something we can do here? Gift money. That's such a great answer. You get a little gift money. Or if they have a little bit of extra money that they can put down, put it down. You know, they said, oh, we got $100,000 to put down. Great. $100,000 put down and they're at 80.01. You got an extra $5,000 borrowed on a credit card. Your debt to income ratio might go up a little bit. Do you have that room? Do that. Yes. A lender's credit sometimes will work. Does anybody know how a lender's credit works? That's a great thing to bring up. So let's talk about that for a second. Let me ask you guys a question. Have you ever heard advertised on TV? Was it something I said, sir?
No, I have to make it very important.
All right, you do that. But you're going to make a deal? Here's the deal. If you make money on that deal, we get 10%.
Make it 5. Make it 5.
Go. All right. Let's negotiate. So, lender's credit. You ever hear on TV that there are mortgages, no closing costs? How many people think that's BS? Yeah, it is. It's BS. People have to get paid. People work, processors, underwriters. Everybody has to get paid. You got to keep the lights on. So, the money's got to come from somewhere. Is it going to come from the bank that's making your loan? Let me do it for free. I'll pay everybody and you get a free mortgage. It's not going to happen. So here's what happens. Let's say that if I make a mortgage, I'm going to sell it to the secondary market. When I sell it to the secondary market, they're going to give me back a certain amount of money for it. So you know what? I got a little time here. I'm going to actually give you this example here. I'm going to take a minute to explain exactly how this works, and we'll come back to the lender's credits and how it works. Does anybody know what par interest rate means? Anybody know what the word in golf par means? Something that I never shoot, by the way, but it means even money. If it's a par 4, you want to shoot, right? Here's what par money means in lending. When I make a loan, I don't hold on to the loan. Most lenders don't. Citibank and Chase might. They portfolio will hold on to loans. But most mortgage lenders sell their loans to the secondary market. Fannie Mae, Freddie Mac, Ginnie Mae, or Wall Street. Got it? So we sell it and we get back money. So here's the way it works. Let's say that I own a mortgage company. I open up a mortgage company. And I say the minimum amount of money I want to earn on every loan that I make is $5,000. Can I do that? I'm in a free country. I can do that. I might be pricing myself out of the market. Maybe I'm, whatever it is. But just for the purposes of the class, I make $5,000 minimum on my loans. Fair enough? So let's say that, hi, what's your name? Margaret. So Margaret, you come into my office and you say, Doug, I'd like to make a loan today for $100,000 at 5%. Today, 5% is par. It's even money. Are you with me? So you come to my class, or you come to my office, and I make you a loan for $100,000. You're going to sign two important documents aside from the deed. Does anybody know what they are? The promissory note and the mortgage. By the way, who's the mortgagor? The borrower. And the easy way to remember that is the borrower is the mortgagor. So I always say the mortgagor is the borrower. Just remember that, right? They're making the mortgage. So I just lent you $100,000. Are you with me? Now I have a negotiable instrument, the note and the mortgage, and I sell it to Wall Street. I sold it at par. I made the rate par. How much do I get back from Wall Street? Who said nothing? 5,000. Who said nothing? They're all afraid now. Who said nothing? Okay, hi. You want to put $1 on your answer? Sure. You guys thought gambling time was over? I'm warming you up for Caesar's Palace. That is an incorrect answer, but thank you for playing. Who said $5,000 over here? Would you like to put $1 on your answer? That's an incorrect answer. So we got a couple of answers already. Ready to put this up here? What do you think the answer is? You don't know. Okay. You want to put $1 on that end? No, I can't. So, if I'm in business, I want to make money, right? There are three ways that loan officers technically make money. It's not exactly right what I'm going to show you here, but it's kind of on that track. It used to be like this years ago. This is all going to come back to the lender credit for you. So I can make money up front from the borrower. I can make it from the back end. Or I can make it as a combination of the front and the back end. Now, when I sell that $100,000 loan, did you bring any money to closing? No, you didn't bring any points. I didn't.
3.5.
So I sell it to Wall Street, and I get back $100,000, even money. I did it at par. I gave her a loan at 5%, and I sold it, and I got back my $100,000. By the way, did I make a profit? No. How long is my wife going to allow me to come home? Not long. I can't pay the bills and everything like that. So I can't lend for free. Are you with me?
Yes.
Good. So I want to make how much on my loan? 5,000 is a minimum. We're using a small loan, 100,000, just so we can calculate our rate. It's really a high-cost loan what I'm doing. It's not really what we do. But you know I want to make 5,000. So you come in the next day and you say, Doug, I'd like to make a $100,000 loan. And I say to you, do you mind paying any points? And she says, Doug, I have no problem. How many points do I have to bring?
1,000.
You get customers like that? Of course not. I say, all right, I need you to bring how much money to closing?
1,000.
5,000. How many points is that?
5,000.
5 points. Why? Because 1 point is equal to? Don't say 1,000. In this case it is, but 1 point is equal to 1% of the loan amount. That's the most correct answer. But in this case, you're right, it's 1,000. So I need you to bring 5 points to closing, $5,000. So when you come to closing, you're going to give me 5,000 in this hand. What are you going to sign?
Promissory note.
Promissory note and a mortgage, aside from other things. I'm going to give you with my right hand what? $100,000. Technically, how much did she really borrow? $95,000. That's where APR comes in, because there was a $5,000 cost of credit. We're not going to go into that. But was there a benefit to the borrower? What was the benefit? She gets the 5% interest rate, which is good for her. When I sell that loan to Wall Street at 5%, how much do I get back? $100,000. Did I make a profit?
Yes.
I did. How much did I make? 5,000. Where did it come from? Upfront points from the borrower. So I made my money, and you got a great interest rate. Fair enough? Great. You come in the next day, you want to make a loan. And I say, hey, do you mind paying any points? And you go, all right, I'll pay a few points. And I say, okay. Well, let's say you said, no, I'm not paying any points, because that happens a lot. I don't want to pay points. I say, no problem. So if I say no problem, I'm going to have to charge her a higher interest rate. So I charge her 6% in this example, right? Now, she gets a 6% interest rate. When I sell it to Wall Street, that's a premium. I have extra profit in that loan because I sold it for a higher interest rate. Are you with me? When I sell it to Wall Street in this example, how much do you think I'll get back from them? $105,000. They'll pay me part of the profit, the extra profit that's being made. So I'm going to make my money on the back end. I made no money on the front end. I made all my money on the back end. It's premium pricing. Are you with me? Next time you come in, I go, do you mind paying any points? You go, I'll pay a few. So you bring 2.5 points to closing, 2,500. I give you 100,000. What do you think your rate might be? 5.5% is correct. So I sell it to Wall Street. Wall Street pays me how much? $102,500 because I sold it above par. Oh, at 6% I made 5 points. At 5.5% I made 2.5 points. So I made 2.5 points from you. I made 2.5 points, 2,500 on the back end. I made my 5,000. Everybody good? That's called premium pricing. So here's what happens when you have lender's credit and you have no closing costs. Oh crap. What they're doing is they're raising your interest rate and they're paying your closing costs because there's more profit in the loan when they sell it to the secondary market. So ultimately, who's paying the closing costs? No, you. Who said they are?
The buyers.
You, a buyer. I thought you meant the bank. I was about to jump all over you. Holy cow. The buyer, the borrower is paying, not the lender, because they charged you a higher interest rate. But you think, oh, I had no closing costs. So here's what happens with a lender's credit. We sometimes will charge a little bit higher interest rate and then credit back $8,000, $9,000, $10,000 to the borrower to help them with their closing costs. Does that make sense? But that's where the money comes from. It's called premium pricing. Fair enough? No seller's concession, but you can do both. You can do a seller's concession and a